As credit froze up during the Eurozone crisis, businesses and governments were finding it hard to fund projects.
The good health of Europe's financial sector remains of paramount importance since growth has evaporated and deflation looms.
With the hope, of course, that the banks will then lend money into the Eurozone. That's the biggest issue. Will the banks feel the confidence to lend money? Will companies be there to take this money? And could that help from what looks to be a lot of deflationary worries here in the Eurozone?
Miranda Xafa, a CG Senior Fellow, explains why European businesses had few options.
European businesses are heavily dependent on the banking system to supply credit. Bank loans represent more than 3/4 of finance to companies in Europe. By contrast, the United States has the most liquid and deepest capital markets, where companies are funded primarily by issuing debt and equity in capital markets.
To take just one example, if EU venture capital markets were as developed as those in the US, companies would have been able to tap into an extra 90 billion euros between 2008 and 2013.
Businesses need money to invest, grow, and thrive in today's economy. Now, there are several ways that businesses can access funding. In Europe, they mainly rely on taking out loans from banks. The problem is that during financial crises, bank lending tends to dry up. In the United States, on the other hand, they tend to go to capital markets, which means they issue stocks and bonds which are bought by investors at market prices.
Capital Markets Union was motivated by the slow recovery of Europe from the global financial crisis and by the need to identify alternative sources of funding at a time when European banks were deleveraging and bank credit was shrinking.
We want to remove the barriers that stand between investors and investment opportunities. And we want to make the system for channeling those funds more efficient.
Capital markets are markets for buying and selling financial assets, such as corporate bonds and equities. And a European Capital Markets Union would be a large market where capital would move seamlessly across national borders, bringing together suppliers of capital, such as individuals and institutional investors like pension funds, and users of funds like companies, governments, and individuals. Deeper integration of bond and equity markets would help promote risk sharing across national borders and thus increase the stability of the financial system. It would also provide much needed equity capital and promote job creation and growth by providing financing to small firms with large growth potential.
The idea of a European Capital Markets Union is very similar to the work that the EU is doing to establish the banking union. However, establishing common standards and regulations for capital markets might be a little more complex than it was for banking.
At present, there are many impediments to the free flow of capital in Europe, including company listings, different accounting standards, different audit standards, and different tax treatment of investments, to name just a few.
Changes to the political landscape have also affected progress towards establishing the European Capital Markets Union.
After a strong start, Capital Markets Union implementation slowed after Britain voted to exit the EU.
Across the world, people have been watching the choice that Britain has made. I would reassure those markets and investors that Britain's economy is fundamentally strong.
Brexit would have profound implications on the UK financial sector and London's standing as a global financial hub. Opinion is divided on how Brexit would affect the whole Capital Markets Union project. Some observers believe that it creates an opportunity for a vigorous relaunch of the CMU agenda. There is little doubt that at some point the project will continue among the 27 continental European countries. Right now, however, policymakers' attention has been diverted to the Brexit negotiations.